In today's Beat and Ask series, we are going to interview Lee Kian Soon. He's the fund manager of Astral Asset Management, specializing in Asian equities. So let's find out how Kian Soon manages his hedge fund with 5 value investing strategies.
What was the motivation for you to move into the field of investments?
I think for me, I grew up in a shophouse and was always curious about how business work. I was helping my parents to run the shophouse's business, and we are always trying to meet ends meet, be very conscious of cost, and at the same time looking at how to expand our business by pricing it differently, by offering more interesting products to our customers. And over time, when I was working in McKinsey as my management consultant, I think one of our key roles was to help our client in terms of enhancing the business revenue, as well as looking at opportunities for improving the profits and so on and so forth. And this has led on to my interest in terms of how business functions, how business deliver values to their shareholders over the longer time, and how business could innovate and create more value for the customers, as well as how businesses could control costs efficiently. And all this has facilitated as well as has triggered an interest for me to study all kinds of listed companies in Asia, as we are experiencing a period of tremendous business growth, and hence we could see how in each sector, in each industry, who are the market leaders and who are not performing so well.
How do you get started in investing and eventually starting a fund?
My co-fund manager Sean and I were hired as investment professionals to manage an investment portfolio for a family office more than 10 years ago. Our investment objective was to deliver above market returns and at the same time have better risk management, reduce the portfolio volatility, and as well as to enhance the portfolio drawdown losses. So we actually have that in mind, and over the last 10 years we have improved our investment processes and have a decent track record, and that's why we launched our own fund. We are very positive about the market potential in Asia. If last century was a US century, we believe this one will be in Asia. We believe there are many investors that are keen and believe in the Asian growth story, and that's why we launched our fund, Astral Value Funds, to focus on Asian listed equities.
We know that you have 5 value investing strategies that you use in your fund. Would you be able to briefly explain to us these strategies?
We believe that value investing goes beyond the traditional classifications of deep value investing, which is to buy cheap relative to intrinsic earnings as well as asset prices. We believe there are 4 other situations that give rise to value investing. Namely, firstly, buying fast-growing companies at mature valuations. Secondly, paying a fair price for franchise company, which are companies that have a dominant position in the industries as well as a defensible mode. Thirdly, looking for sustainable high income situations. And last but not least, fishing out turnaround and special situations. By investing in a variety of value investing situations, we believe the value of the portfolio could be better protected, especially during market downturns. If in good times, most of these strategies would perform relatively well. However, in bad times, if you have a portfolio made up of purely deep value investing situations, the portfolio is more likely going to be cheaper. If you have a portfolio made up of simply high growth companies, the portfolio might be hugely discounted. In other cases where there are franchise and sustainable high income situations, the portfolio will be more defensible and also provides room for us to look for better opportunities in other situations when the market condition changes.
Would you be able to give us an example of each of the strategy that you use?
I think for the high growth situations at mature valuations, right, we are looking at Shabu, which is one of the hot pot companies in China that has expanded rapidly from 100 stores to now currently 600-700 stores, and they have continued to do it at with no gearing, using the cash flows from their business and operations. They have done very well over the last 2 years, and we've seen their share price basically quadrupled during the period. Another example that for deep value investing would be Lai Feng, which and the Lai San Group shares, because they were trading at huge discounts, basically at 0.1 to NAV. And this is one example of a company, real estate company that is trading at deep discounts. But subsequently the share prices soar up, and that creates a lot of value for investors. I think for franchise companies, our example would be Sunny Vision, which is a data center that is based in Hong Kong. Its business is very sticky because if you are providing data center services to high-tech companies as well as to key financial companies, they are very unlikely to change their data centers overnight because it involves a lot of work to move data centers. Hence, they are able to have a lot of pricing power. And at the same time, this company is way underpriced, in our opinion, versus the data center business in the United States. And that's why we see there's a huge potential for Sunny Vision. Currently, it was listed in the gem market in Hong Kong, and because it's doing so well, its market cap has grown so tremendously fast that now is moving to the main board of Hong Kong Stock Exchange. The last example will be for the special situations, and I think I would like to draw an example that is more closer to home, which is GLP. The privatization of GLP is fairly early announced, and the announcements was created a lot of media reports and publications about a buyout from one of their senior management teams on GLP, and we think that that was a good opportunity because GLP was undervalued, and hence we ride on a bandwagon that on these special situations, and we benefited from a privatization offer bid, which allow us to exit the stocks at a very good returns and at a decent valuation.
What gave you the confidence in these strategies?
I think right from the start, we can't claim any exclusive rights to these investment strategies as they've been tested and tried over time. We have learned how Warren Buffett, Benjamin Graham, and Peter Lynch have employed such strategies to deliver phenomenal investment returns over time in the United States in an era where there is good business growth and economic prosperity. We believe we can use these strategies similarly in Asia, as now we are going through this golden window of business prosperity as well. In terms of track record, I think our fund has delivered 23% year to date from inception till October. And in the era of 2012 to 2014, we have delivered over 45% absolute return. In addition, our diversified strategy is also the reason why we managed to deliver single-digit loss in the period of May 2015 and early 2016, whereas the markets where we invest in, namely Singapore and Hong Kong, the key indices have declined more than 20% at that point of time.
What do you think are the challenges for an investor if they use any of these strategies?
I think there are three basic elements to remember here. Firstly, principles and theory. I think this is the easiest part because most, if not all investors could grasp the fundamentals of value investing and reiterate them from time to time. Secondly, I think execution and portfolio management is also key. The key challenges here is to devote sufficient time and energy to conduct the market research as well as to monitor the portfolio on a periodic basis. Last and most importantly, temperament. This is the hardest and most tricky part, as one has to fight the emotion and behavior part and not be tempted nor be distracted. We have observed some individual investors who started enthusiastically but could not sustain this over the longer time. Nevertheless, if an investor is interested in value investing, the key of adopting this strategy is to be disciplined and not to be distracted by short-term price volatility.
How much time do you think an investor would need to do in terms of research when employing these strategies?
Basically, I think it depends on how big the portfolio of companies the investor is looking at. If you are looking at a realistic number of companies of around 10 companies, right, I think regular review as well as research of 1-2 hours per week would be more than sufficient in order to basically ensure there's sufficient coverage for the entire portfolio. Any more companies would definitely requires more time and effort, as one needs to go through the documents of the company, i.e. the financial reports, the analyst coverage, as well as understanding what is happening in the industry or sector. That's why I recommend for individual investors, keep it to 10 to 15 companies, and it also depends on number of sectors. keep it to a couple of sectors that you're familiar with so that you could be more efficient when you conduct your company research, given that companies from the same industries tends to be easier to manage and you can group all of them together. And going through this requires 3 to 4 hours per week, and on a monthly basis you could do a more rigorous half a day kind of review.
Assuming you are a 30-year-old investor with $50,000 to invest, which strategies would you recommend to start with?
I would propose starting with a deep value investing. The reason as such, the principles are fairly easy to understand, and it involves learning the fundamental business and financial metrics and ratios. Execution is also fairly straightforward, rule-based, so that it's easy to identify the so-called good value companies. Patience and ability to hold over the long term is key here, as adopting such a strategy requires one not to be distracted by short-term events. In addition, one has to watch out for the so-called value traps, because a lot of companies appear to be cheap, but the main reason for doing so is because they are facing significant financial troubles and may not survive over the long term. Hence, it is crucial to be able to analyze these companies' financials and business performance and before making an investment decisions. I think the hardest to start with would be turnaround and specific situations, because these do not happen often. At the same time, the amount of research that is required for such investing strategy is more extensive, because a lot of time you have very limited time for special situations, be it a privatization play or be it an M&A situation that you have to make an investment decision on. This requires you to be at the right place at the right time, talk to the people during the very limited offering periods, and make a quick investment decision. This, for a start, for a retail investment person, would be very difficult, because sometimes people are not available during specific events, and hence they will miss the opportunity.